All right, let's dive into a compliance puzzle that I know is hitting the desks of more and more tax pros every single year: dual enrollment. You've got these incredibly sharp high school kids earning real college credits, which is awesome. The problem? They are running headfirst into a tax code that was written for a totally different era. So today, we're going to pull apart the audit risks and, more importantly, find the strategic plays hidden inside these complex rules.
And this quote, man, it really just hits the nail on the head. That's the whole issue right there. You have this wave of academic ambition pushing education forward, but the Internal Revenue Code is like a brick wall with these super rigid, kind of ancient definitions of what a college student even is. And that collision? That's what's causing the mistakes, the compliance headaches, and the audit notices.
So here's our game plan. First, we'll unpack the central paradox of dual enrollment. Then, we'll put the two big tax credits, the AOTC and the LLC, head-to-head. After that, we're going to expose the single biggest trap with the AOTC, before showing you the safer, correct path with the lifetime learning credit. And to wrap up, we'll touch on some new laws and give you a rock-solid compliance strategy to take back to your practice.
Okay, Section 1. Let's talk about this fundamental disconnect. From an academic standpoint, these students are absolutely college students. They're doing the work, they're in the classes, they're earning the credit. But in the world of the IRS, they're treated like something totally different. And that gap, the one between what's happening in the classroom and what's written in the tax code, that is a serious compliance minefield for your clients and, frankly, for you.
You know, when the tax code, specifically IRC Section 25A, was drafted, the authors were picturing a very traditional student. You know the one. 18 years old, high school diploma in hand, officially accepted and enrolled in a university. But dual enrollment students, they shatter that mold. The college registrar will typically classify them as non-degree seeking or maybe special students. And that one little administrative detail, it has massive, massive tax consequences. So what tools do we even have to work with here? Well, under IRC Section 25A, we've got two main players on the field. There's the American Opportunity Tax Credit, or AOTC, and the Lifetime Learning Credit, the LLC. Understanding the nuance between these two isn't just a good idea. It's absolutely critical if you want to keep your clients compliant and out of trouble.
Now, when you just look at them side by side, your eyes are going to go straight to the AOTC, right? Of course. It's bigger, a $2,500 credit, and it's even partially refundable. It's the shiny new car. But, and this is a huge but, claiming it is like running an obstacle course of really strict rules. On the other hand, you've got the LLC. Sure, it's a little smaller, it's non-refundable, but its eligibility is so much broader, which makes it the safer, more flexible, and frankly, correct tool for the specific job.
And the differences get even more stark when you look at what you can actually claim as an expense. This is a huge tripwire. With the AOTC, things are pretty generous. You can claim books bought from anywhere, even a new laptop if it's required for the course. But the LLC? It's way more strict. See those big, bold no's? If the family buys books from a third-party seller like Amazon, it doesn't count. If they buy a computer, it doesn't count, unless those items are required to be paid directly to the school. This is a massive point of error on so many returns.
Okay, this brings us to the main event. The single biggest, most common reason that AOTC claims for high school students get denied in an audit. And listen, it has nothing to do with the students' grades or how many credits they're taking or how hard the classes are. It all comes down to the failure to meet one simple requirement: being a degree candidate.
So what does the IRS even mean by that phrase, degree candidate? Well, their definition is laser-focused. It means the student is officially enrolled in a program that leads to a degree or some other formal credential. The problem is, most colleges have a rule. You cannot be formally admitted into a degree program until you have a high school diploma. So that dual enrollment student is administratively classified as non-degree seeking, or NDS. This isn't an opinion. It's their official status on the university's books.
And, you don't have to just take my word for it. This isn't some gray area we have to guess about. The IRS has laid out its position for us in black and white. If you pull up Publication 970 and go to Example 3, they give us a specific case study that just removes all doubt.
And there it is, the IRS's own logic, right on the page. This example about Larry is definitive. He's taking real college classes, but as it says right there, he wasn't enrolled as part of a degree program simply because he doesn't have his diploma yet. The IRS's conclusion? Larry wasn't an eligible student. That right there is the smoking gun that auditors use every time.
So, if the AOTC is basically a trap waiting to be sprung, what is the right way forward?
Well, this leads us directly to the lifetime learning credit, which really acts as a safe harbor in almost every dual enrollment situation you're going to see.
The real power of the LLC is its flexibility. It completely scraps that rigid degree candidate requirement. Instead, it has this wonderfully broad skills test. A course qualifies as long as it's taken to acquire or improve job skills. And you can easily argue that foundational courses, we're talking English 101, college algebra, biology, are fundamental to pretty much any future career. It's the perfect fit.
Now, choosing the LLC is the right first step, but you have to calculate it correctly. And that means understanding a term called Adjusted Qualified Education Expenses, or AQE. It's a simple but absolutely critical three-step formula. Step 1, you start with the total expenses paid for tuition and fees. Step 2, and you cannot miss this, you have to subtract any tax-free money the student received. This could be state funding, grants, you name it. That's per IRC Section 25A, G2, the no double dipping rule. And what's left over? That's your AQE, the magic number you use to actually calculate the credit.
Let's make this concrete with a real-world example from Georgia's dual enrollment program. The state pays for a student's first 30 credit hours. That's all tax-free aid, so it gets subtracted out. But once those hours are used up, the family has to pay. So in this case, the family paid $1,500 out of pocket for extra classes. That $1,500 is the AQE. It's the amount they personally paid. The lifetime learning credit would then be 20% of that amount.
All right, let's kick it up a notch and get into some more advanced topics. There's been some recent legislation that has really changed the playing field, and there are a couple of hidden risks and audit triggers that every single tax pro needs to have on their radar. So, a really big development here came from the One Big Beautiful Bill Act of 2025. This law actually went in and changed the rules for Section 529 plans specifically to help with situations like dual enrollment. Now here's the crucial part. It now allows families to take tax-free distributions from a 529 to pay for books and computers. You know, the exact expenses the LLC doesn't cover. This is a total game changer for financial planning.
Okay, now here is a weird and frankly dangerous little paradox hidden in the code. Under IRC Section 117, scholarships are only tax-free if the student is a candidate for a degree. See the problem? That exact same non-degree seeking status that disqualifies them from the AOTC, well, by a strict reading of the law, it also makes the tuition money paid by the state technically taxable scholarship income. Now, this is rarely enforced, but it is written in the code, and it's a potential liability you have to be aware of.
So what's going to actually trigger that letter from the IRS? Well, there are three big red flags. First, an age mismatch. The IRS's computers are programmed to see an AOTC claim for a 16 or 17-year-old and immediately flag it for review. Second, claiming a credit without a corresponding Form 1098-T. And third, the big one, double dipping. The IRS matching programs are designed to compare Form 8863 for the credits with Form 1099-Q for 529 plans to catch anyone trying to get two tax benefits for the same dollar.
So what's your defense when that notice shows up? It's one thing, meticulous documentation. Now, it's really important to tell your clients that not getting a 1098-T does not legally mean they can't claim a credit. A lot of colleges won't even send one if the state paid the whole bill. However, the burden of proof now shifts entirely to the taxpayer. You have got to have the records, bank statements, canceled checks, the official transcript ready to go to prove your case.
Okay, let's put all the pieces together and build a clear, actionable compliance strategy. The whole point here is to shift your clients from being reactive when April 15th rolls around to being proactive and planning for this stuff all year long.
Here's your playbook. The key takeaways. First, your default position should always be the lifetime learning credit. It's the compliant choice. Second, just avoid the AOTC for dual enrollment students. Period. You'll sidestep the audit risk, and more importantly, you won't waste one of the students' precious 4 years of AOTC eligibility before they even get to college full-time. Third, calculate that AQEE with surgical precision. And finally, get strategic. Segregate the expenses. Have clients pay tuition out of pocket to claim the LLC, and then use those newly flexible 529 funds to pay for the books and computer tax-free.
And really, this all boils down to one crucial question you should be posing to your clients. Is their tax return just an afterthought, something they deal with at the end of the year, or is it a core, strategic part of how they plan to pay for their child's education? Because when you get this right, tax compliance stops being a burden and becomes a powerful financial planning tool that maximizes benefits and minimizes risk.